We were going to talk a little bit about the concept of waterfalls. And when we talk about waterfalls in the personal finance and investing space, we're talking about this concept that you only have a certain amount of money. So what you do is you pour it like water into the top waterfall, and that pool is full, it spills over into the next pool and into the next pool once that pool's full and into the next pool. And you might get down 5, 6, 7 pools, whatever, and then you run out of money. Okay. And what that waterfall represents is the best uses for your money. And that might be paying on a debt. It might be maxing out some type of a retirement account. For example, a waterfall that we've put together to help people decide what to do next, because it's hard in the beginning, right? This is all kind of new to you, and you got 12 great uses for money, and you're like, how do I prioritize these? But here's one way you can prioritize these, and we call it the waterfall of tax efficient investing. And that first pool is your employer provided retirement plan match, right? The match is free money. If you just save something for retirement, you get paid more by your employer. Maybe it's 50% of the first 6% of your salary that you put into that account. That's your first priority, because not getting it is leaving part of your salary on the table. So you put enough money, enough water into that pool so you get the full match from the employer. Then it spills over into the next pool. And the next pool should be high interest rate debt, right? Now, what's high? Well, probably more than 6%, maybe more than 8%. Certainly any sort of credit card debt at 15 or 30% is in that category, right? This is a high priority. Your guaranteed investments out there are paying you something like 4 or 4.5% these days, right? So if you can get a guaranteed return from paying down an 8% debt, that's pretty attractive. Yeah, you might do a little better than that if you have a particularly good real estate investment, or maybe stocks have a good year. Maybe you can borrow at 8% and come out ahead investing. But for the most part, when you get into those higher interest rate debts, it's a pretty good option. So we have that as our second pool. The third pool, I would put a health savings account. It's one of the major priorities for us every year because it's triple tax free. You get a tax break when the money goes in, it grows tax free. When it comes out and is spent on healthcare, it comes out tax free. It's triple tax free. It's a really, really tax advantaged account. And so that one really comes next. Okay. And then next, in the waterfall, once you've filled that out, right, you got your match, you paid off all your high interest rate debt, you now maxed out your HSA for the year. That's probably where your retirement account comes, and maybe it's a solo 401k if you're self-employed. Maybe it's a 403b, if you're at a academic center, whatever. But you max that out next. Okay? It might be $23,500 this year. Still got more money you can put away toward building wealth? Well, that's where we start looking at a backdoor Roth, both for yourself and for your spouse. If you're under 50, that's $7,000 this year for each of you. Right? Still got more? Well, you can always invest more in taxable, right? And that pool actually never ends, right? Because you could put $10 million a year into a taxable brokerage account if you wanted to. But sometimes people put a limit on that and they say, I want to invest this much into, index funds in a taxable account, and then we're going to stop doing this, and I'm going to go buy a rental property, some sort of alternative investment, or I want to put $10,000 into Bitcoin if I can, or whatever, right? You get to design this waterfall yourself, and at this point, you can pick anything you want. Other people, they're very debt averse, and they're going to put even low interest rate debt into the waterfall at about that point. I know we didn't really have much of a taxable brokerage account until we'd paid off our mortgage. It was important to us to pay off a mortgage. And so before we had much of a taxable brokerage account, we actually dedicated money toward paying off the mortgage. And then, of course, that allows you down the road to invest even more into a taxable brokerage account. But that's the concept of a waterfall, right? You're moving from one pool to another. You are, engaging with your financial priorities in the order in which you have prioritized them. Right? Your money is going toward what you value the most. And I think that intentionality is really valuable. And the concept is helpful for those of you that are early in career and you've got these dozen things that are good to do with your money. Maybe it's beefing up your emergency fund and paying off this debt and that debt and this debt. And you got all these new retirement accounts you want to take advantage of. And, maybe you want to be a landlord. And so you want to do some of that. And you want to take your kids to Europe or whatever. You got all these priorities. Well, you got to list them out in the order in which you care about them most and start addressing them, start working down them. And you will find, like Matt found, as you go through that first decade or so of your career and your financial life, that some of those start going away, right? You pay off the debts or you no longer have whatever that priority was. And pretty soon, instead of working with a dozen of them, you're only working with three of them. And your life actually becomes a lot more simple.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.